Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast. My name is Ian Saunders, and we're lucky this week to be joined by a special guest, Matt Kaufman, who is the global head of ETFs at Calamos. Matt, thank you very much for joining us today.
Thanks, Ian. Great to be here.
Wonderful. So I know that there's a lot going on across the ETF space and a lot of movement over the past few months in particular. We'll dive into some few specific areas today, but maybe can we start things off? Just can you tell us a little bit about Calamos and then specifically kind of what your role entails with the firm?
Sure. Yeah, Calamos, for those not familiar, is a 45-year-old alts manager and risk manager. The firm was founded in 1977 by John Calamos, former Air Force pilot. We launched on the heels of a convertible bond, I'd say Renaissance in America. That was a great way to manage risk. In the 70s, the option market was just getting started. The Chicago Board Options Exchange was launched in the 70s. And you could now get customized exposures and convertible-like exposures to the market. A convertible will tie your upside to the stock price of a corporation. And on the downside, you're tied to the fixed income portion or the bond of a company. So that convert market, has grown tremendously over the years. But Calamos is the largest convertible bond manager in the country. That convert space, that has a payoff profile that looks a lot like a lot of the strategies we are seeing in the ETF space today. So, what is old is new again. But I'm at Calamos here. I've been here for about 2 years, building out the ETF business. The interesting story there is John Calamos, reached out and said, we need ETFs. And, we know that ETFs have been around for 20 years or so, or 30 years by this time. But what we've seen is the SEC has opened the doors for, not needing exemptive relief to build ETFs. And so we met and I said, the good news is that all of the strategies that Calamos is great at are now making their way into the ETF category. So you might not be 30 years late. We might actually be, right at the right time, the precipice of this adoption of options-based strategies, and that fits squarely into what Calamos is good at. So great time to be in ETFs. I think the timing was right for this one.
Yeah, yeah, absolutely. So how many ETFs does Calamos have?
We have around 40 ETFs. If you take a lot of our outcome-based strategies that are launched every month and give you a 1 year outcome period, so we have 100% principal protected ETFs that are designed to give you principal protection over a 1 year outcome period. We do that on the S&P, Nasdaq, Russell. We also have Bitcoin that offers various protection levels. So that lineup will add up quickly if you count each of those months as a single fund. But strategy-wise, we have about 8 different strategies that we are running. So we have those outcome-based solutions. We built the first 1 year principal protected ETFs as rates were rising higher. The buffered space was great when rates were low. That space really took off in the insurance world in the mid 2010s, right around 2012 was the first buffered annuity. That made its way into the ETF space. I was at Milliman for a long time, and we built the intellectual property for the buffered ETF space. Then Calamos built out some convertible type strategies. Interestingly enough, you can use convertibles to provide equity like upside returns. And so we built a high delta equity sensitive convertible portfolio. It's been outperforming the S&P 500 and the Nasdaq 100 over since inception here. Just looking at the calendar, largely because you can get access to companies who are performing well. If they're performing well, that means their convertible bonds are performing well as well, or moving up the price track, up the curve. We launched another ETF that was with you all with partnership with Nasdaq, CANQ, which combines fixed income. It's an actively managed fixed income bucket, and then the upside of Nasdaq 100 stocks that are selected, largely by our portfolio managers. Try to give exposure to the top 30 there. And that has done extremely well also. It's a convertible-like exposure, but you're not tied to the specific corporate bonds because a lot of companies in the Nasdaq 100 just don't issue convertibles. They don't need to. They don't need that financing, but we can create that type of exposure. So historically we've been seeing about 80% of the upside to the Nasdaq 100 and about 60 to 65% of the downside. So really good risk reward trade-off there. That product's been in the market for over a year, performing very well. And then our latest fund that we brought out is the Auto-Callable Income ETF. So this is CAIQ. We call that CAIQ, around our office just to give it a name. It's on the back of CAIE, which was the flagship offering for the auto-callable income space. That is squarely a derivative income category that did not exist in the ETF world, and we brought that into the ETF market. So there's a lot of funds that are going to be coming out, not just from Calamos, but it's creating a whole new category of derivative income. I'm sure that's largely what we'll dive into here. So maybe I'll stop talking and pass it back to you.
Yeah, no, absolutely. All that's helpful perspective. I think maybe since you mentioned it there in the auto callable space, I mean that's a term, to be frank, before hearing about your funds, I hadn't really heard about too much.
Sure.
So would you mind kind of giving us like what does auto callable mean?
Yeah,
And I guess how does that relate maybe to other options overlay derivative income kind of
sure.
funds in the space?
Yeah, I'll give you a headline of what CAIQ is. It's really a revolutionary form of income. It's derived from equity markets, so similar to covered call income, you're getting equity-derived income from the equity markets rather than bonds. So the result, going to the conclusion, then we can unpack this over the next 15, 20
Mhm.
minutes. You get high, stable, and tax-efficient monthly income with measured exposure to the equity markets. So you can think of an auto-callable yield strategy a lot like a bond. So if we can just retrain our mind from the equity markets to a bond that will pay you a coupon and return your principal at par, either at maturity of the note or if you're called away early, that's as the name implies. So you're getting a monthly coupon that's tied to the equity markets, and then you're getting your money back at par as long as the equity markets don't fall too far. So that's the high level approach to this. If you're an options person or you're familiar with covered call ETFs, so covered call ETFs, you're selling off your upside, you're collecting an income payment for that, and then that income you collect is tied to factors like equity market volatility, dividend rates in the market, interest rates. Well, we have solved for a lot of those variable parameters, but that is the covered call space. It's about $150 billion market in the United States. It's growing tremendously. There's a lot of covered call ETFs in the market now. I spent in my earlier career at PowerShares. We built one of the first, I think the first buy right ETF in 2007. Not many people bought it back then. I think it was a little too soon for its time. But now we're at this space where we've got a tremendous amount of people looking to equity markets for income. So let's go to the structured note side of the house for a minute. Derivative income dominates that space as well. And it's done through the auto-callable income note. And the simplest way to think about that, we talk about it as a bond with monthly income and return of principal, but it's really a long-dated put-right strategy. So the covered call space is dominating ETFs. The long-dated put writing strategy is dominating structured notes. It's about a $100 billion market, and we brought that into the ETF world. So, take a 5-year, put option. You cannot go to the listed options markets and get something out 5 years that also has a call feature, the auto callable as it's in the name. So it's a long-dated put writing strategy with a call feature and then a 40%, or in this case, 30% downside barrier to your money. So the
Okay.
way we can play that out, we've done this maybe a game with our internal sales. We've done this a couple times of just using a monopoly money analogy. So if Ian, let's say you give me $100, monopoly money, a bill. So I've got your $100 here, and then we're going to tie that $100 to the S&P 500. So we're going to give you a monthly income payment. Let's say it's 12% annualized, just to make it easy, $1 a month. So if the S&P 500 is up next month, you're going to get $1. If it's flat the next month since inception of you giving me that $100, then you're still getting a dollar. If the next month the S&P's down by 25%, then you're getting a dollar. Well, let's use the Nasdaq since this is a Nasdaq,
I
Nasdaq.
was gonna say that's a
Yeah,
good
we
one.
appreciate it. Sorry about that. So yeah, if the Nasdaq 100 then is down by 35%, so it's below the 30% barrier, then you do not get your dollar for that month. And then the
Got it.
next month, if the Nasdaq is up again, above that 30% barrier, then you're going to start getting your dollar again. So that's how the strategy works. Your income is paid to you as long as, that underlying Nasdaq index is above a barrier. And then the same is true at maturity. So if this is a 5-year maturity barrier tied to the Nasdaq 100, as long as the Nasdaq is not down by 30%, 5 years from the start of that, the very last day of that option, that's when your principal is going to be at risk. So you'll return all principal as long as that underlying reference index is above minus 30%. What are the odds? The odds are that you're going to get called away early. If the
Hmm.
reference index is positive after a year, you get called away, you get your principal back in the beginning of the ladder for our strategy, which we'll dive into. But in a normal auto-callable note, you get your principal back, the show's over, and you have to, find a new auto-callable note to invest in.
Okay.
So you can see the benefits of this. A lot of advisors like this because there's a high degree of protection to that principal. There's a high degree of protection to the coupon. And they take on, or I guess they would deal with the inefficiencies of getting called away, getting your money back, having to reinvest those proceeds. It's somewhat tax inefficient, it's operationally inefficient, but nonetheless, it's a $100 billion market
Hmm.
in the US. And so what we did at Calamos is we took that strategy. We partnered with JP Morgan. We used their auto-callable yield note pricing methodology on a Mercube Nasdaq 100 index. It's a volatility controlled index, which we can talk about, and we laddered exposure to this. So you're not just getting, access to one auto callable, you're getting access to a weekly laddered exposure of auto callables. So every week there's a new one going into the portfolio, and that really reduces your coupon payment risk. It reduces your principal maturity barrier risk. So if you look at the index that we've built with Mercube, the Nasdaq 100 volatility advantage index, you would have never breached principal barrier going back to 2005. Yeah, if I had to guess, you probably would during the tech bubble crash. But the options, vol surfaces go back to '05, and so you can't
Right.
go back too much further. But looking at that history, you never would have breached principal barrier, and you would have received an average coupon of about 16%. Right now, it's in the high 17. So really high, stable, tax efficient income that's tied to equity markets. Again, that is the high level conclusion, of the strategy. So we're excited to partner with Nasdaq on this one, and the flagship offering has nearly 500 million in assets in just under a few months here. So it's growing extremely fast. The space is growing, and so this is a great way to give people a Nasdaq flavor of that auto callable income.
Yeah, absolutely. I mean, that is it sure sounds like an extremely interesting product. And this just launched in just the last month, right? In November.
That's right. Yeah, just within the last few weeks here. Today's the third, so we got a bell ringing at Nasdaq this afternoon.
Ah,
It should be
nice.
fun to announce the product to the world here.
There you go. That's great. There are a couple things I want to dive into there, but just because we were
Sure.
talking about the fund, I want to mention to those listening that might be following along on the Dorsey Wright platform because it's launched so frequent or so recently. We don't have the price data yet to put that up as a chart on our platform. So if you're looking it up, we'll get that up as soon as possible. But just one thing to note on that front. You mentioned there, so looking at the underlying index attractive. What was the terminology? Volatility controlled or
Yeah, so let's maybe frame this around
right?
covered calls first. So if you use a covered call strategy, you're selling an option, you're collecting a premium income for that option. And whenever you sell the option, the amount of money that you can collect is going to be influenced by interest rates, by volatility in the Nasdaq 100, and also by dividend yield and a few other things. So what we have done by working with Mercube is stabilized volatility and dividends. And so that would mean when we're actually selling an option, we're collecting roughly the same coupon. We're collecting about 13% over the risk-free rate. So we're still exposed to interest rate movements, but it's going to be about 12 to 13% over the risk-free rate. And so you can go to our website. Now we've built a dashboard that shows the pricing of all of the autocallables, the position of each one. You can see the term sheet for each one, the coupons that we're paying for each one, and they're highly stable because we've stabilized parameters of the options pricing model. So I think you'd said a lot of the audience here is our financial advisors, so we can get a little bit into the weeds, which
Yeah.
can be fun. Um, so we've stabilized the volatility of the reference index that we're selling that long dated put option on at 35%. And so that allows for a high premium every week when we're writing a new auto callable option. We're collecting a very high and stable premium. And then we're using a NASDAQ 100 futures based index. So that eliminates any dividend risk that we might otherwise be exposed to. So when you put all of those things together, we've stabilized the options pricing parameters that we were able to control, and that in turn equates to a high stable coupon for the end investor. If you ladder all of that together, you wouldn't want to just go out and invest in a high 35% vol targeted Nasdaq 100 product that would give you a really volatile experience.
Mhm.
When you tie that to an auto callable and ladder it out 52 or more times, and then you put a 30% barrier on all of it, what you're left with is an experience that looks a lot like the underlying benchmark, a lot like the NASDAQ 100 over time. And that was ultimately the goal. The goal was to deliver a high, stable, tax efficient coupon in a way that over the long term looks a lot like the NASDAQ 100. So then the trade-off being, if you're comfortable with equity market like risk, with traditional NASDAQ 100 like risk, you can exchange that for a high stable coupon.
Interesting. Interesting. So, and I think you mentioned you talking about different kind of market conditions there over time. Um, is there market conditions that an approach like this would do better in, or maybe do worse in, or like
Yeah,
where might it face kind of headwinds?
Yeah, so thinking back toward our monopoly example, you can translate that into NASDAQ 100 examples. So in NASDAQ 100 up markets, you have some upside risk of not capturing all of that upside. We're trading off your upside for a coupon. So
Got it.
if the NASDAQ 100 is up 40%, you're going to make about 17 to 18%. Whatever that weighted average coupon is
Hmm.
what you're going to collect. So you be aware of that. And then in a flat market, you're going to outperform the NASDAQ 100. You're still collecting that coupon. In a down market, you're still collecting the coupon as long as the market is not down by that 30% for a severe sustained time period. That would be the environment where some of your coupons might turn off. Again, you got 52 checkpoints across time. And so the market would have to stay down, below that barrier for a long time period, which we have not really seen. The Nasdaq has tended to recover very quickly.
Very sharp.
Yeah.
Yeah.
Yeah, and that'd be your risk scenario. You are trading equity tail risk for a high stable coupon. So those are the scenarios where you would want to be aware of the risk reward trade-offs. The severe sustained market decline that fails to recover would be the coupon risk, and then the risk of principal maturity below the barrier. But again, we have not seen that
Right.
historically looking at the index. It was designed, on purpose this way.
Right. And so if you're in a more consistent kind of steady eddy up into the right environment, I mean, that's the kind of environment where something like this would shine.
That would be a phenomenal environment. That would you're all 52 of these underlying auto calls, again, they're a lot like bonds. So in that environment, they would collectively be trading around par, right around 100. If the market starts to correct, I would view all of those auto callables like rubber bands. As the market starts to correct, those rubber bands will stretch down and trade at a discount to par. They're
Hmm.
mark to market, they're trading every day, which gives you good liquidity in the ETF. And as the market goes down, they'll draw down. So if you want to be tactical, you could buy in at that discount and you've built in some capital appreciation potential for yourself. So if the Nasdaq 100 is down, 20, 30%, and you don't think you're going to breach those barriers, those rubber bands aren't going to break, then you can capture all of that upside as the market recovers or as you go toward maturity, your 5-year maturity. And then you're going to get that plus the 17 or 18% coupon. So there are some pretty remarkable years where you would have captured significant capital appreciation if you're buying in at that discount to par plus the coupon. So it's an interesting product, and we've given you all of that information on our website.
Mhm.
You can go there, make decisions for yourself, see where the product is trading. You can find great opportunities to buy at discounts. Some just buy and hold it. They want that tax efficient coupon. They're fine buying in at par. Others are looking for opportunities to buy in at a discount.
Got it. Got it. That makes sense. You mentioned the tax efficiency. I mean, is there any other tax considerations that advisors need to consider for a product like this?
Yeah, thanks for bringing that up. So we do all of our Calamos ETFs with tax efficiency in mind. It's one of our core tenets of product development here. We want to make sure everything we do is as tax efficient as possible. And maybe not even as possible, but like what can we do that people might not think is possible in terms of tax efficiency? So from the perspective of the coupon that we're paying out, the distribution we're paying out, about 90% or more of that is expected to be tax deferred. So that will be treated as return of capital. It'll reduce your cost basis. That will show up on line 3 of your 1099 at the end of the year. And then if you sell after holding for longer than 1 year, you'll pay long-term capital gains rates on that income. And then if you don't sell, if you just hold, your cost basis will erode over time. It'll go to zero. The IRS doesn't allow your cost basis to go below zero. So once you've eroded that, then any additional income will be treated as long-term capital gains.
Okay.
So there's a tremendous tax efficiency built into the product.
Right.
Some advisors are using this as an income generating tool, and then they'll bequest those shares to heirs. Maybe they don't need 17% income, they might want 7%, and they'll reinvest the other 10, which will just create a long cost basis for yourself over time. And then you can bequest those shares to heirs, or maybe it's a charitable gift that will give the receiver a step up in basis. So there's some really interesting tax considerations that you could do here, to largely create, tax-free income for somebody for either as long as they live or be tax deferred until they sell, at which point it's long-term capital gains.
Wow. Yeah. I mean, that sounds especially interesting. I know we're in the kind of the continuous aspect of the great wealth transfer. I mean, sounds like a super interesting
Yeah,
product
for
for
sure.
that in particular. When you're looking at, so you mentioned there a little bit kind of functionally how someone might, an advisor might kind of use it. Where do you typically see this fitting into someone's portfolio from a broader kind of portfolio allocation perspective?
Yeah, there's a couple ways we're seeing advisors use this. You need to be comfortable with equity market-like risk. So the underlying portfolio will act a lot like the Nasdaq 100 over time. If you look historically, the volatility's been in line with the Nasdaq 100 over time. So people are replacing equity exposure for this income payment. A lot of folks are moving toward seeking income. If you don't think the equity markets are moving up by 17% over the next year or so, this would be a way to essentially lock that in as long as those underlying barriers aren't breached and your coupons are turned off. So a lot of folks are replacing with equity exposure. Others are replacing high yield bond exposure, correlating that to the financial crisis where some of those high yield bonds defaulted, and here some of your coupons might turn off in that type of environment. So we've got some folks using it that way. An interesting one that I've seen is tax efficient income. So a lot of folks are using municipal bonds for tax efficient income. You've got to use a lot of that muni bond exposure. Some are using, safer munis and then high yield munis. Whereas here, we can allow you to keep that core muni exposure and maybe swap out some high yield munis for CAIQ, and you get highly tax efficient income. And you only need to use a little bit of CAIQ in order to do that.
Hmm. Interesting.
Yeah, this is probably off topic. It reminds me of that Life Water commercial where, the guy's like squirting the water bottle or squirting this stuff in the water bottle. He's like, "Oh, how much do I use?" He's like, "Oh, you can squirt a little or you can squirt a lot." So I just kind of
Love
came.
Love that. I think taking it a little bit of a step back from a broader perspective, the broader derivative income kind of oriented space, right? I mean, that's continued to grow. You mentioned especially on the buffered side, grew. I mean, that's different with options overlays, obviously. It grew a lot in the lower rate environment. I mean, if we're looking forward, is there a rate environment that would be better or worse for this kind of space? Or how do you see that kind of progressing? I guess as we look at it over the next, not asking you to give rate calls, we're going out, but
Oh
just
no, yeah, for sure. So this is tied to rates, but let's just take the terminal conclusion. If rates go to zero, you're going to get about 13%.
right,
So we have stabilized a lot of the parameters, which allows me to say that type of statement. So if interest rates go to zero, you will still see a coupon of about 13%. That's in each auto call as it's going into the portfolio. So there's a bit of a lag effect, which is beneficial in falling rate environments. So if rates start to come down on Friday, the new auto call that's going into the portfolio will have a little bit lower of a rate, but you still have at least 51 others that are tied to that higher rate that are just playing out over time. So that's why we've got such a high stable coupon. So yeah, again, in that rate environment, you'll be about 13% over risk-free rate over the SOFR, the overnight rate. So if rates go higher, your coupon's going to go up. If rates go lower, your terminal lower bound is probably about 13%.
gotcha, gotcha. And so if we're looking out, rates kind of continue to like I know Fed's president or president another Fed cut in
Mhm.
December, and then obviously we've priced in a lot of Fed cuts over the past year or so, and not all of
Yeah.
those have come to fruition. So like, we'll
Right.
see. We'll see what actually shakes out. Where can advisors go to kind of learn more about this? You mentioned the website. I looking at the graph. I mean, being a chart guy myself, the autocallable dashboard is pretty cool to look at over time. Calamos.com, best place. Any other?
I would go to calamos.com. Yeah, I would encourage you to take a look at that dashboard. Reach out. We're happy to walk you through it, but that's a patent pending tool for advisors. A picture is worth 1,000 words, and so go to that dashboard. You can see exactly what's happening under the hood of CAIQ. You can see the position of every auto callable. You can see it over time. Where is it relative to how much time is remaining? You can see all of the standardized parameters for each one. But the high level, overview is that we have built all of this for as complicated as you can make CAIQ or any option strategy for that matter. The end result is this high, stable, tax efficient coupon, which gives you an easier way to help a client understand, what's going on here. And it creates some consistency to that income as well, which I think a lot of the original covered call strategies have not been able to do. And so this is an evolution of that market. It's going to continue to grow. But yeah, feel free to reach out. We'd love to talk to you. Happy to do one-on-one, and I would use our website, to dive in as deep as you'd like.
And I assume contact information is on the website as well.
Correct. That's right.
Okay, wonderful, great. Well, Matt, thank you very much for hopping on here with us this week.
Ian, thanks for having me.
Thanks everyone also for tuning in. We'll be back to touch base with you next week.